Because the DuPont case is such an important case and it's so important for you to understand what really is going on, I'm just going to refresh your memory very quickly. We had sort of talked about why a financial buyer would be interested in the DuPont coatings division. And I was walking you through how you could have gone about analyzing, how much is it that a private equity fund or a financial buyer should pay. And so I want to just refresh your memory about a few of the pieces of information that are given to you in this case. You are sort of given this main template in Exhibit 9, in which some of the underlying assumptions about sales growth and all of that sort of follows through into your cash flow estimates. And so you are already told that Ellen Kullman is expecting sales growth of 4% for the next 5 years. You are already told that the margins are expected to be 10%. And based on an enterprise value terminal and EBITDA multiple of 7, it is expected that right now, DuPont Performance Coatings is worth about $4 billion or $3.97 billion. Right? So this piece of information was given to you. We said, what if a financial buyer can come in and change this sales growth rate from maybe 4 to 5%? And so notice that as soon as you do 5%, it changes the numbers here, right? So that's why this template was sort of convenient, because everything was following through. And so if you change this to 5%, you change this to 5, 5, 5, and 5. And then if you change this to 12, which was the other thing that I had asked you to do, like what if the financial buyer can come in and improve the margins from 10 to 12? So you increase all of these to 12. And all of a sudden you see that just by making these operational improvements, the worth of DuPont Performance Coatings shoots up by about $1 billion. So just on the basis of this, it's just the whole division is worth more. This is an important point. Normally when people say, oh, financial buyer will come in and they'll take on a whole lot of debt and try to make this firm or division valuable, people usually sort of think that, oh, all this value is coming through in the form of debt and tax shields. And that's not true. While it is true that debt will create some value through the tax shields, as we'll see, you can already see that most of the value increase is coming in the form of operational improvements. And this is what these private equity groups like Carlyle and all that are good at. They know where to cut costs and how to drive growth. And so that's where a financial buyer would sort of see, like, where is the value creation happening. So just on the basis of that, DuPont Performance Coatings might be like a valuable target for a financial buyer. So that's the first thing that I'd ask you to take a look at. The other suggestion was that what if towards the end, the enterprise value or the terminal EBITDA multiple is 7 instead of 7, maybe it's 7.5, right? And so once you do this automatically will have an impact on this terminal value number over here. This shoots up to 6187. And I just wanted to make sure that you understand, like, this is perhaps, like, if you go into the ISS case, this is perhaps the most important thing that you need to understand. And I touched upon it last time, and I want to touch upon this again. Look, maybe if I show you. What is happening over here? So typically this is how you've done valuation. So you maybe are at this point. So here's 1, 2, 3, 4, 5. The standard way in which you've done calculation is this. You say financial cash flow 1, financial cash flow 2, all the way till like financial cash flow 5. And then let's suppose that beyond this, you say that there's going to be this constant growth rate, right? And somebody asks you, okay, these are unlevered cash flows, right? So these are financial cash flows or unlevered cash flows. Somebody says, what is the enterprise value? What is the value of these cash flows? Or what is the enterprise value of this firm? You say, okay, I'm going to discount these. Now, the standard approach that you have used is this. That you says it's the WACC approach. In the WACC approach, you basically said, I'll take the financial cash flow 1, I'll divide it by 1 plus the WACC, and so on and so forth. You go all the way out till like financial cash flow 5, divide by 1 plus WACC, raised to the power 5. And then finally, at this point, you calculate something like the terminal value as well, right? Which is based off of the fact that beyond this point, you have this constant growth. And traditionally, or more conventionally, what you've done is that you've calculated this terminal value 5 as whatever your financial cash flow 6 is divided by R minus G, where R is your discount rate, and because you've been discounting at WACC, this basically is your WACC. Are you with me? This is what you've typically done. And so more specifically here, because come on. Sorry, just give me a second. Okay, right, so basically you then say, okay, I'll take my terminal value at the end of year 5 as well, right, which I've calculated using this formula, and I'll divide that by 1 plus the WACC, right? So this is what you've typically, right, this is what you've typically done to calculate the enterprise value. Okay, so a couple of things. We know from our previous discussion that WACC you can only use when there is like a constant debt to equity ratio or a constant debt ratio that is being presumed for the entire forecasting period. But what if that is not the case? What if the debt levels are changing? So then we say, you know what, we can use something like the APV approach, the adjusted present value approach. The adjusted present value approach would say, you know what, figure out first the value of the unlevered firm, or the enterprise value of the firm as if it were unlevered, in which case you would take your financial cash flows, the same unlevered cash flows that you have here, but the way you would go about them is that you would first discount them at 1 plus your unlevered cost of equity, which is R naught, right? You do this, you keep on going till like financial cash flow at the end of year 5 divided by 1 plus R naught raised to the power 5. And then if you're expecting your financial cash flows to grow at a constant rate, then what would you do? You'd again calculate terminal value, but here your R would be like your R naught, right? Because you're not using WACC anymore. You're first determining the enterprise value of the unlevered firm. And so, excuse me, so you'd say terminal value again divided by 1 plus R naught raised to the power 5. But here, this terminal value would be financial cash flow in year 6 divided by R naught minus G. Right? So again, all that you're doing is first figuring out the enterprise value of the unlevered firm. And then what are you going to do on top of that? Once you've done this, then you say, oh, wait a minute, all of this calculation is being done under the assumption that the firm is completely unlevered, right? My unlevered cash flows discounted at the unlevered cost of equity. So then on top of that, you add what? Present value of the interest tax shields. You calculate that separately. And the important point here is that because all of this calculation has been done as if the firm is entirely unlevered, present value of the interest tax shields, the way you'll calculate them, must account for the interest tax shields that will not only exist in year 1, but also in year 2, 3, 4, 5, in fact, in perpetuity. Because the effect of debt hasn't been captured anywhere so far in this calculation. Okay, so that's what I'm trying to say. And so we've done this in the Sampa video case as well. Now, the broader point that I'm trying to make is this. These are new set of slides. Come to that later. sometimes you can have situations, and this is very, very important, please understand this. Sometimes you can have situations where you might say, hey, for the first 5 or 6 years, our debt level is going to be changing, maybe because we are in a situation where the firm has been bought out by like a private equity fund and they're going to be paying off debt. So for the first 4 or 5 years, the approach that you want to use to evaluate is like the APV approach. But after 5 years, maybe the capital structure is going to remain constant, and then another approach becomes relevant, right? So what I'm trying to say is this: take the exact same situation, this is very important for you to understand, exact same situation where you have cash flows for years 1 to 5, you have financial cash flows. Let's suppose that for this time period, the debt level is changing, maybe because you're amortizing debt, right? So here you have like varying or known debt levels, you're amortizing debt. But let's suppose that beyond this point, maybe the debt to equity ratio is going to be a constant number. Now, if that is the case, then what I'm saying to you is that you can calculate terminal value at the end of year 5 as if you're going to have like a constant debt ratio, which means that you will have something like financial cash flow year 6 divided by WACC minus G beyond this. But you will still need to figure out the enterprise the values over here using something like the APV approach, because here you're dealing with debt levels. And so what I'm saying to you is that for calculating enterprise values over here or values over here, you'll say, I want to do value of the unlevered firm plus present value of interest tax shields. The main point over here is this, that in this kind of a situation where you're mixing and matching 2 valuation approaches, here the interest tax shields will only be calculated for the first 5 years, because after that, debt becomes constant, debt ratio becomes constant rather, and any effect of debt on the interest tax shields will already be embedded in this WACC, right? So you don't need to account for interest tax shields there. Yes?
And so when, in this case, you said we didn't need to calculate further because they were going to pay like 7 times EBITDA, so the 7 times EBITDA like factors in what the net present value is. Precisely, and that's the point that I'm trying to make over here. When you go back to this Excel sheet over here, and you say, look, the terminal enterprise value, the terminal EBITDA multiple is 7.5. The point that I'm trying to make is that this already captures the worth of the enterprise and already reflects whatever debt is going to exist or debt ratio is going to exist. Look, it doesn't even have to be the case that beyond this point, debt ratio is constant. But the fact that this is an enterprise value multiple means that this already, like when you calculate enterprise value using this, you're like, this is enterprise value. This is not value of the unlevered firm. This is enterprise value, the 6187 right here. This is enterprise value, which is already capturing the worth of the enterprise at this point, which includes both the value of debt and equity. Right? So my point is that beyond this point, you don't need to worry about what debt is going to be, what the interest tax shields are going to be, because this guy already captures it. So that is precisely why when you were implementing the APV approach over here, as I'm going to do that right now as well, you were only concerned with the interest tax shields over here. So then you were like, okay, I'm going to determine the value of the unlevered firm for year 1 plus the tax shields, and then 2 tax shields, 3 tax shields, and then take this enterprise value and then discount it back. That's it. I don't need to worry about the interest tax shields beyond this point. In the ISS case, that might not be very relevant, just saying, right? In the ISS case, depending on how the calculations are done, you may actually need to calculate the value of the unlevered firm through and through, and then calculate the present value of the interest tax shield through and through, because you don't have a structure like this. Okay, so just putting it out there. But do you understand? Do you understand the main idea? Don't feel that you cannot mix and match the valuation approaches. for a certain time period, a certain valuation approach might be relevant. Like in this case, for the first 5 years, the APV is doing the task. Beyond this, some approach like the WACC is doing the task, which is helping you get this sort of terminal value, right? Behind the scenes. So that's kind of the idea. So anyway, that was a long-winded way of sort of explaining what the 7.5 is capturing. One other thing that I wanted to point out, that if you actually go and take a look at this terminal value, the way it is being calculated, it seems like there is a whole lot of multiplication going on over here. What's really happening is this. Basically, when it says that the EBITDA multiple, terminal EBITDA multiple is 7.5, that basically means that the enterprise value to EBITDA is 7.5. Okay, this is what it means. And the fact that it is terminal means that it is at the end of year 5. So you're saying, okay, terminal value at the end of year 5 is basically what is the enterprise value. Sorry, no, I'm sorry, shouldn't say, this is the multiple, right? So this is the multiple, this is already 7.5. This enterprise value at the end of year 5 is what we're trying to calculate. The way it is being calculated in this Excel sheet is that this multiple is actually what is referred to as a forward multiple, which basically means that this enterprise value at the end of year 5 is a function of the EBITDA that you're expecting in year 6. And so basically, if you solve this out, enterprise value at the end of year 5 is basically EBITDA 6 multiplied by 7.5. And EBITDA 6 is basically expected to be a certain growth rate above EBITDA 5. So EBITDA 5 into 1 plus 4%, which this 4% is sort of given in the template. So basically, this is what's happening. This is how you're getting this enterprise value at the end of year 5. And this is precisely what we're calling the terminal value. So actually the calculation that you see in Excel is basically this stuff going on. And so if you go back to the Excel, you'll see that this is exactly what's happening. We're taking the EBITDA at the end of year 5, 786, multiplying it by 1 plus the 5%, which is the growth, sales growth, which will influence EBITDA here, and multiplying that by the 7.5 over here. So this is where this is coming from. Are you with me here? I'm sorry if I'm belaboring on this, but I want to make sure that everybody's on board with this because this is an important case. But anyway, with all of this done, so now all you have is like, what is the worth of DuPont Coatings division? And right now we're still in the unlevered world. But then I said, okay, you know what? What if the firm takes on some debt? Now, before we approach that question, one thing that I think I mentioned this last time as well, that even if a private equity fund says, oh, you know what, these are the cash flows that we can get from DuPont Performance Coatings, if you actually calculate, let me sort of insert additional rows here. Sorry. If you actually calculate the NPV of all of these cash flows at a required rate of return of 20%, which is what I had asked you to sort of do. So you do this, you find that a private equity fund which is looking to generate a rate of return of 20% for its limited partners would not want to bid more than $3.7 billion for DuPont Performance Coatings, right? So in other words, if I'm a private equity fund and I go to my limited partners and they say, hey guys, how much are you willing to put in to get these cash flows if you want a 20% return on your investment? These guys will say 3.7 billion, which obviously Ellen Kullman is going to have an issue with, because just as the way the company stands, the division stands, it's already close to 4 billion. But what is the implicit assumption? The implicit assumption here is that all the funding is going to come in the form of equity. It is only when all the funding occurs in the form of equity that equity holders are going to be like, okay, well, if we are the only ones who are going to be pitching in all the money, then maximum that we'll pitch in is 3.7 because that tells us that we'll get 20%. which is precisely why, in order to generate a rate of return of 20% for the limited partners, private equity fund is going to say, okay, guys, hold on. We'll take less money from you. We'll take some debt financing because that will help leverage the returns. So now let's see how that changes things. And so I had asked you to say, okay, you know what? Go over here and assume that the debt to EBITDA multiple that we can get is 6 times. So this is 6 times the EBITDA that you're expecting in 2012. And so basically what that means is that your debt level, the amount of debt that you're planning on taking at 2011 is basically 6 multiplied by this 12 EBITDA in 2012. So this is the amount of debt that you're planning on taking. Now this debt is a double-edged. It's having 2 concurrent impacts. One, this debt clearly will increase the value of the coatings division a little bit because of the interest tax shields. So that's one. But the second, perhaps equally important impact is that it is going to reduce the amount of capital that equity holders will have to put in, which will leverage the returns. Okay, so let's see the impact of both. So let's see. So this is the important part. So I said, okay, let's suppose that this is the amount of debt that we're taking. This means that interest expense over here in 2012, this is going to be equal to the blended interest rate on debt, so 6.75%. I'm going to lock this, multiplied by the debt outstanding, 3926. And then I had told you last time that you need to multiply this by -1 because this is, so you want to make sure that this is an expense, right? So now all of a sudden you see that the amount of cash flow that is coming to the equity holders, right? It's not having any impact on unlevered cash flows. Notice they remain the same because these by definition are unlevered. They shouldn't get impacted with leverage. But the levered cash flows will deduct these interest expenses so that cash flow to equity holders is 174. But then what is it that I said that we're assuming? We're assuming, let's assume that there is a cash sweep. Cash sweep is our way of saying that let's suppose that whatever money is left behind after paying any interest expense, we're going to use all of that to retire debt. So I said, okay, assume, so I inserted 2 additional rows here. So principal repayments. And I said, by definition, make that equal to -1 times whatever this is. So that by definition, true residual cash flows or true flow to equity. And by true, I mean that true in the sense that whatever is left behind after making principal payments, right? That by definition will be equal to this plus this, which, oh, sorry. This will be equal to this plus this. By definition, it is 0. In other words, we're saying equity holders get nothing. When they make the principal repayments, they get nothing, right? So that's called a cash sweep, sweeping away all the cash. Now, this, I said, will have an impact on your outstanding debt balance. So here, your debt balance will, right, of the 3926, you have paid back 173.67. So I'm going to take that and add this guy, 3753. This in turn will have an impact on my interest expense next year. So I'm going to copy this formula and paste it here, which then basically means that now I'm making a lower interest payment, which leaves a little bit more for me to repay the debt. And so I will again copy this formula over here, Control C here and Control V here to denote how much I'm repaying back. So basically equity holders get nothing, which then of course has an impact on the outstanding debt balance over here. And so now I'm just going to copy paste this through and through. If you complete the exercise, copy the interest expense and follow it through and through here. And then copy this guy and follow through here, and then do this here. Basically, this is the picture that emerges. So that over time, if the private equity fund is going to do a cash sweep, then it's going to pay off about $1 billion worth of debt in the 5 years. Yes. Now let's look at the first thing. How does this debt increase the amount that the private equity fund is willing to pay for DuPont performance coatings? Well, we know that there are going to be interest tax shields. So now you can calculate interest tax shields. Interest tax shields here are equal to the interest expense that you're paying, which is right here. Interest expense, you multiply it by the tax rate, 25%, and I want to lock this, make sure you lock this, right, so that this doesn't change. And I want to make sure that this comes out a positive number, because E31, which is my interest expense, this is a negative number, so I want to make sure that this is a positive, so I'll multiply this by -1, so it gives me 66. And then I copy this and paste this through and through. So my interest tax shields are this is the amount of money that I'm saving in taxes because of the interest expense, right? So why am I doing this? Because 5102 over here already reflects the value of the unlevered cash flows at the unlevered cost of equity. Right, so all of this is just at the unlevered cost of equity right here, 11.2%. I'm just adding the tax shields, and this terminal value then already captures, the effect of capital structure beyond this point. So what I'm going to do here is that I'm going to say equal to, like, the present value of tax shield is NPV. Now here's the thing. What discount rate should I use over here to determine the present value of the interest tax sheets? Yes.
The cost of debt.
And what's the reason for that?
Since the debt levels are high.
Yeah, so here we are fairly sure of the debt levels that are existing, right? So the debt ratio is changing, right? The debt ratio is changing, but the debt levels are known. And that is why for situations where you have a relatively more certainty about the debt levels that are going to exist, I've said, you should use the cost of debt. And so for that reason, you should use the 6.75%. I'm going to lock this and then basically discount all of these. And so the enterprise value with tax shields comes out to 5350. So this is the max, this is the absolute max that a private equity fund would be willing to pay. Where will the money come from? Where will the money come from to pay this? Like, if the private equity fund were paying all of this, where's the money coming from? Well, partly, right? If you actually go back and take a look at how much debt you're taking on, you're taking 3926 worth of debt. So where's the rest going to come from? The rest is going to come from the equity holders. So let's suppose equity holders at this point, at the point of making the purchase, they would need to put in equal to whatever is the, let's suppose that this is the max. This is like, let's suppose that the private equity firm is paying the max for this. So basically the difference between this guy and this guy, this is the equity contribution, 1423. Now here's a silly question. If you are a private equity fund and you have just figured out that you want to pay about 5.35 billion for DuPont performance coatings, and you go to your limited partners, your institutional funds, and say, hey guys, found a great division, it's unlevered. Would you give me 1.4 billion? In return, I'll give you nothing in the first year, nothing in the second year, nothing in the third year, nothing in the fourth year, nothing in the fifth year. How does that sound? You'd be like, yeah, here, sure, take my 1.4 billion, right? No, so I'm like, What's going on? Why would the equity holders ever consider giving 1.4 billion to you if you're coming up to them and say, all the money that we're going to make, we're just going to try to pay off debt? What do the equity holders get?
6 billion at the end of it, right?
Almost.
So,
Almost.
yeah, they get a percentage of the whatever they exit at.
Yeah. So notice that what's going to happen by the end of year 5, the entire enterprise is worth something. Yeah. In fact, what is that worth? That is the 6187. This is the entire worth of the enterprise that we determined based on the multiple that we're presuming will exist. But this is the entire worth of the enterprise. Shareholders, right now we are looking at the equity holders perspective. What do the equity holders get? Equity holders are, we're saying you'll have to put in 1.4 billion. They get nothing. Towards the end, the enterprise is worth 6187. Do equity holders have claim on all of that? No. What do they have claim over? This minus any amount of debt that is outstanding at this point. And what do you know? Based on the amortization schedule that we have, we know exactly how much debt will be outstanding over here. So if I were to, let me insert maybe 2 additional rows here. If I were to call something like terminal value of equity, not terminal value, but terminal value of equity, then at this point, equity holders are essentially getting this minus whatever is the level of debt outstanding. So it's not that the equity holders aren't really getting anything. Towards the end of it, their equity that they would have put into this business would be worth about 3.3 billion. So if I were to then say, okay, the really true flow to equity, which basically means including terminal value of equity, right? I'm just being loose with terminology here, but I hope you understand what I'm saying, right? Basically what this means is like the flow to equity, which now also includes like the value of equity that will exist here. This basically then is equal to this plus this. Oh, Excel caught on to my, true. This plus this. So Control C, V. And so what you're really asking the equity holders, would you put in, would you invest -1 multiplied by this over here? Would you invest this much to get this? Actually, if you actually look at the internal rate of return that you would generate on this investment as an equity holders, that actually, right? So all I do is find out the IRR of these values. Actually, let me make this is percent. Hey, it's pretty close to the 20%, right? It's about 18.82%. It's still not quite there, but so maybe the equity holders would want to pay maybe a little bit less, right? So basically, instead of paying like the full 5.3 billion, maybe, right? So what I'm saying to you is that maybe what the private equity fund might want to do is not want to pay the full 5.3 billion, but maybe a little bit less, so that the equity contribution of the equity holders maybe drops down to maybe a little bit lower than 1.4 billion, so that the IRR or the rate of return that they make is 20%. Do you see what's happening here? Leverage has 2 impacts. And one is it increases the value of the enterprise a little bit through these tax shields, but perhaps more importantly, without the use of leverage, a private equity fund cannot hope to generate a rate of return of 20% for their equity holders, right? Which is why they're doing this then. Yes?
I'm trying to understand, I guess, more from like particularly on the Miller stuff.
Mm-hmm.
It seems almost as if like the real value creation, so to speak, is like the bank just kind of giving the P for money in a way, because the bank is willing to accept a very low interest rate for taking on its part of the capital structure,
Mhm.
and the equity holders are really making money off the fact that their IRR has to be like 20%, whereas the bank can take 6%.
Mhm.
Why does that difference exist if the risk is supposedly like relatively similar?
Actually, it's not, because debt holders have senior claim. So if this is like, if the debt holders have, so first of all, debt holders do have senior claim.
Okay.
So they will be willing to accept a lower rate of return because they're taking on less risk compared to the equity holders. Equity holders are taking two risks over here. First, just the operational risk and the fact that they are residual claimants, but also they want the 20% because there is so much debt in place that it's increasing the beta. In fact, I'll show you how this impacts the beta and then the required rate of return in just a minute as well. But the way, so there's an added element to this, of course, as well. Private equity funds and the investments that limited partners make in them generally tend to be illiquid. You're like, okay, I can't see you can't see your money for the next 5, 6, 10 years. To be compensated for that illiquidity, also you want compensation as well. So the 20% reflects a mix and match of all of those things. Illiquidity plus the higher risk which is embedded in private equity.
Okay. Just conceptually, it's really weird just because there's like, I guess the argument, like, it seems like there's a linear like risk reward or like payoff structure like throughout finance, but it also seems kind of like the LBO is like a misnomer. Like, you're not really creating value, just taking more risk, right? That's what's really
again, I'm not quite true. They are creating value because they're the ones who are going to try to push up the sales growth rate from 4 to 5%, and they're the ones who are going to try to increase the margins from 10 to 12%. So and that's precisely why I was saying that, it's not just about changing the capital structure and creating value. It's more about using that to boost the returns for your limited partners, but basically trying to get this done. This is where they make their most money. Plus, the other thing that I want you to note is that this is a blended interest rate. When I say blended interest rate, you'll have like some senior debt, maybe some mezzanine debt, maybe some junior debt. So depending on how much of it is, like, and especially what DuPont Coatings division is going for it is that it has a lot of tangible assets given the nature of its business. So it's able to securitize or rather collateralize a lot of the debt that it's taking on. So that could also explain this 6.75% and why it's relatively on the low side. Plus, of course, this is happening in 2011, where already the interest rates are on the low side. So that's basically what's happening. The one thing might bug you a little bit, and it's kind of related to the question that Chad asked. What's with this 20%? Why do the equity holders require 20%? I mean, yeah, okay, sure, it's sort of the norm in the private equity industry, just 20%. But why? Why 20%? And yeah,
it's riskier than just putting your money in like an index fund.
Well, sure. Yeah, sure. But why not 15%? Why 20%? Right? I guess that's more of my point. And the reason why I'm asking is this: what have we learned? We have learned that the rate of return that the equity holders will require on their investment, given a certain amount of business risk, that will change with debt, right? If the debt ratio is going up, you will require more. If the debt ratio is going down, you'll require less risk. So the required rate of return should go up and down with financial risk. Yes? Okay. Notice that here, you're starting out. Notice that over here, you're starting out with a high level of debt in the private equity fund, and then you're retiring it and retiring some more, more and more. And yet we said, like, so technically what you should expect to see is that as the debt level is falling, you should technically have different required rate of returns by the equity holders. Equity holders should require maybe a higher rate of return in year 1, but a slightly lower one in year 2, slightly lower in year 3 than year 4, right? So technically the required rate of return of equity holders should be different at different points. But we're saying, no, it's a flat 20%.
you see? So what I want to show you is this. So technically that is exactly right. That is exactly right. In fact, consider the following exercise. Okay. All right. So let's suppose, let's suppose that I am measuring the debt to equity ratio. Let's start from year 5. Do I know what the debt to equity ratio will be at this point?
Yep.
Yes, because I know that the terminal value, the total enterprise value is this. Yes, and I know how much the debt will be outstanding. So the debt to equity ratio at this point, at the end of year 5, will simply be the amount of debt over here. So maybe I should, so equal to debt divided by, and I know that the terminal value of equity or the worth of equity at this point is going to be 3371. I just did this math with you right here. So I know that the debt to equity, and let me just sort of do this. So the debt to equity ratio that will exist over here is going to be this. So that's the first thing. Yeah. All right. Now, I want to refresh your memory. You might recall that with known levels of debt, the relationship that exists between equity beta and asset beta is 1 plus B over S into 1 minus T times the asset beta. The difference is this 1 minus T bit. This, like I said, again, because we're dealing with known debt levels here, so 1 minus T will appear in this formula. So what I'm going to do now is that given the debt to equity ratio that I've calculated just now, we know the tax rate and we also know DuPont's asset beta because that's given, it's unlevered. I'm going to try to deduce what the equity beta is going to be at that point. Okay, so that I'm going to implement this formula. So I say, okay, you know what? Let's determine the equity beta, which should exist at this point. So notice, by the way, this information is kind of hidden. If you look at the footnotes, right? So let me take you back. See this unlevered cost of equity that you used is 11.2. Right here in the footnotes, it says this has been calculated using unlevered beta of 1.2. This is the asset beta, risk-free rate of 4%, and a market risk premium of 6%. So we're going to make use of this information. So we're going to say this is the equal to 1 plus the debt to equity ratio multiplied by 1 minus the tax rate. The tax rate is given as 25%. So just to save some time, I'm going to enter 0.75, which is 1 minus the 25%. And then I'm going to multiply that by the asset beta, which is 1.2. And again, technically I should be doing cell referencing, but I just want to save some time. So if I do this, right, the equity beta that exists at this point is this. Are you with me? Okay. If I have the equity beta, then I can calculate the cost of equity. Cost of equity, right, which is the required rate of return that equity holders, limited partners in the fund are going to want. And this is simply going to be equal to 4%, which is the risk-free rate, right, which is given here, right, 4%, plus 1.95, which is the equity beta that I've just calculated at this point, multiplied by 6%, which is the market risk premium, again from the footnotes. And I'm going to make this a percent. So the cost of equity that prevails at this point is 15.71%. Are you with me so far?
So what does that number mean if they're to issue like
this means that the rate of return that the equity holders would want at this point on their equity investment would be 15.71%. That's all that it means.
Okay. How does that relate to the 20%?
Yeah, I'm getting there. Okay. All right. So bear with me for like maybe a few more minutes. Okay. All right. So far, so good. This is very important. The next step. Okay, so here's the thing. We were able to deduce, right, at the end of year 5, we were able to deduce that the terminal value of equity or the worth of equity at the end of year 5 is 3371. We also know that at this point, the equity holders require a rate of return on their equity of 15.71. So here's the punchline. If I were to calculate something called the value of equity, I'm not going to use the word terminal here. We already knew that the value of equity at this point, which we called terminal value before, was this. So this is fine. But now I'm saying the following. If you know what the equity is worth here, and if you know what is the discount rate for equity here, then technically you can move 1 year back and deduce the value of equity here. All you need to do is just take this guy and discount it at this 15.71%. Right? This is what the equity holders are getting, 3371. This is the required rate of return on equity. So if I wanted to deduce the amount of the worth of equity at this point, all that I would need to do is do equal to this guy divided by 1 plus this guy. Yes? So the worth of equity at this point is going to be this. Are you with me so far? I'm making a point. All right, I'm getting there. Just follow me. If now you know what the equity is going to be worth here, hey, guess what? If you scroll up, you already know what the debt level is going to be at this point as well. So you can technically just do equal to whatever this formula. So actually calculate the debt to equity ratio at this point, which is the debt to equity debt level at this point, divided by what the equity is going to be worth at this point. No surprises that your debt to equity ratio at this point is higher because you haven't retired as much debt yet. So it's higher, which means that the cost that the equity beta at this point, I'll just copy this formula and paste it here. Equity beta is higher, which means that the cost of equity at this point is a little bit higher. But hey, now you know what the equity holders are getting here. And you know what the discount rate is, move 1 step back. So now you can deduce the worth of equity at this point, right? Which is basically take equity worth here and divide by discount rate here. So now I'll just copy this and paste this here, copy this, paste this here, copy this, paste this here, and then finally copy this, paste this here. Do you see?
Yeah.
Look, the equity holders' required rate of return at the very beginning phase of the LBO was as high as 23% approximately. It started dropping to 20, then 18, then 16, then 15. So why 20%? Because 20% sort of reflects the average rate of return that equity holders will be generating over this 5-year period. So that's where the 20% sort of comes from. But technically speaking, this is how the required rate of return of equity holders should be changing for the risk that they're taking, given the amount of debt that is there in the capital structure. And what is more, effectively now, if you follow through on this, then see, previously when I was explaining this to you, the private equity fund was coming up to the limited partners and saying, hey guys, how much would you be willing to pay if 5 years from now your equity is going to be worth 3371, right? Now, effectively, you're going to your private equity, you're going to your equity holders and you're saying, guys, how much are you willing to invest today if next year you want 174, if next year you're getting 1748. And now basically you know that at this point your required rate of return is going to be 22.79. So equity holders will be like, you know what? The amount of money that we are willing to put in at this point today is simply this guy divided by 1 plus 22.79%. This is how much we're willing to put in, 1424. And you want to see some magic? if you now go to your equity holders and say, okay, guys, we'll take 1424 from you. We'll complement this with, we'll use, so the other source of funding is debt. So we'll take your 1424, we'll add the amount of debt that we're getting from the bank. So the total amount that we are willing to pay for the enterprise is 5350. It's the exact amount that you valued your enterprise at using the APV approach. I've just shown you that the APV approach and the flow to equity approach are exactly consistent, right? The difference was that here I am specifically measuring the exact rate of return that equity holders will want at each stage. I'm saying that once you account for that, the amount that you will come up with will be exactly the same as the APV approach. So just another way of showing you that how the approaches are so consistent with each other. Of course, this is a little bit more involved, to put it lightly, right? But this actually in the PE industry is known as the recursive approach to valuation. Recursive approach to valuation. I'll make this Excel, well, I'll save this and make it available to you, and then I have the whole thing solved as well. So I know it's you should have something to work off of. But as you can see, this is recursive in the sense that you're starting from the very end using some debt to equity ratio that you can get based on the enterprise value you expect and the debt, and then work backwards. So that's why it's called sort of recursive or backward. Well, recursive is the more technically correct word. Blake, does that take care of your concern?
Yeah, I just don't get how, like, that makes sense. I don't know. 'Cause it's like, why would there ever be a bidding war? It's like whatever you ask for is what it's exactly.
Oh, no. Okay, hold on. No.
Yeah.
I'm not saying this is like the absolute max.
Yeah.
Okay, so a couple of things. First of all, this is the absolute max that the PE fund would want to pitch. Now, it doesn't mean that they will actually make this bid. So that's the first thing. You never want to give out the max, right? That's the first thing.
Yeah.
The second thing, and this is where bidding wars come in, is because different firms have different specialities, and different specialities means that different firms have different abilities to create value. You might say, well, the value of the interest tax shields, I mean, given this debt, I mean, there's not much room there. That's fine. But notice that all of this is under the assumption that the PE fund will be able to increase margins from 4 to 5 and sales growth from 4 to 5 and EBIT margin from 10 to 12. What if there is another PE fund which is like, man, we can do such a better job because we can get margins from maybe 12 to 13%. And there might be other PE firms which are like, no, I don't think we can accomplish that. It's a level of expertise, right? It's like, if you try to get into real estate right now, the amount that you'll be willing to pitch for like a building might be very less because you're like, man, I don't know how to, like, who might go to contact and all that. So it's a level of expertise thing as well. Yes.
I guess more my question is like, is this just the case because the cost of equity, the 11.2 just happened to work out as the right discount rate to complement the 20% IRR? Like if you change their cost of equity, would that change the valuation? So that's like, say 14% or 12, like 10%.
Well, I mean, yeah, that would change everything.
So it's kind of just a perfect storm that the cost of equity matched the 20% IRR to make the value.
No. Okay. The 20% is a little bit different. Look, 20%. Okay, I think I see where you're going with this. Okay, look, why I came up with 20% is because 20% is a rough approximation of the required rate of return. A rough approximation. So put differently, here's what you can do. Go back to this situation, right? If you go to your equity holders, go back to this like your really true like Road 41. If you're an equity holder in this fund and you are saying, look, I don't care about the 22.79 and the 20.33 and all of that. I just want a flat 20%. Okay. So then the question is, what is the absolute max that the equity holder would want to put in? Knowing that the equity holder won't get anything in year 1, 2, 3, and 4, but at the end, the equity is going to be worth 3,371. You can actually calculate that. So if you are using a flat 20%, you say, what is the NPV at 20% of these cash flows? And that comes out to 1355. 1355.
Okay.
Which is a little bit less than this 1424 that we have determined. So technically, if this is the case, then the private equity fund is going to say, okay, guys, you want 20%, so give us 1355. We'll add this to the 3926. So the absolute max that we'll be willing to pitch for this firm is 5281. Now, someone like you then goes to the equity holders and says, guys, you're being unreasonable, because you shouldn't demand a flat 20%. Technically, you should want 22.79 here and 20.33 here. And to the extent that you're able to convince them, then the equity holders will be like, oh, okay, I see. So based on that, then I think I can pitch 1424, which then means that you can pitch 535 as a fund.
But if the discount rate for DuPont, their rate that they require was different, the values wouldn't add up, right?
Well, that would change everything in the sense that that would also change the value of the unlevered firm as well. Yeah,
that wouldn't matter to the private equity firm, right? It's just like, I'm just wondering if it's like, would this happen every time that the values would equal, or is this like the perfect scenario?
If you are being consistent in your valuation approaches, the numbers will exactly match up. They will always match up. So in other words, it's not being driven by the fact that the discount rate is 11.2%.
Okay.
Right?
Thank you.
Yeah. Is that all right? Do you understand the recursive approach? Do you understand the flow to equity stuff? You'll so this is, as you can see, slightly involved, but basically that's kind of what the case is about. So I guess I'm laying this out over here, just showing you what happened. What happens? We observed that the largest increase in values comes from operational improvements, about 64%. The tax shield benefit is not all that great. Why? Because we are, first of all, assuming that the PE firm will exit at the end, and the exit multiple already captures the effect of the capital structure beyond year 5. So all of that impact of tax shields beyond year 5 is sort of captured in the multiple of it. That's why we're only using 5 years worth of tax shields. The tax rate, by the way, also in this case is somewhat lower, 25%. Well, now it's 21% for US, but for international firms which have operations in multiple places, depending on where they're exposed to, the blended tax rate can be a little bit lower. So that also explains the slightly lower amount of the interest tax rates. So I've explained all of this. I don't think I need to just walk you through all of this, but we basically observed that in the absence of leverage, the implied enterprise value was lower. But then if you take the leverage, then that is how you can get the 20% return for your equity holders. So anyway, just to make you aware of what actually happened, eventually Carlyle won the bid to get DuPont. They actually paid $4.9 billion in cash. As soon as they did that, they basically renamed the division to Exalta. The other bids that came in were close to $4 billion. So a lot of people were like, hey, Carlyle has lost their discipline, right? Saying Carlyle had lost its discipline, it's not worth $4.9 billion with their overpaying. But Carlyle was pretty sure that they got a good deal because they had more expertise in restructuring operations than perhaps the other groups, so they could see that value sort of coming in. So they spent more than a year separating Exalta's computer system from DuPont, the main DuPont. Of the 17 top executives, 12 were replaced, including the CEO and the CFO. They also did some initiatives in emerging markets. Might surprise you to know, actually, that just 2 years after holding on to Exalta, they did the IPO. Not even the 5 years, 2 years. And when they did it, the IPO was at $19.50 per share, which implied a stock market value of $4.5 billion. They paid 4.9 billion for the entire thing, and then just 2 years later, they got a stock value, just a stock valuation of 4.5 billion. Yeah. So basically, yeah, they made, tons of money on this, right? So regardless of whether the extra shares are sold, Carlyle is getting back most of the cash it put into the buyout just 2 years ago. So basically, it turned out to be a good deal for them. What this goes on to show is that operational improvements and how you can bring them out, that's important. And perhaps most importantly, the timing was really good, right? This was a time when the debt to EBITDA multiples were on the rise, and they sort of timed it right. They didn't hold on to it for the 5 years. It's like, let's just get it out of the way. So that's what happened. Good case? Had fun? Okay, so I do want to start mergers and acquisitions, but yeah, what the heck? Let's start fresh next time. So.